Let's begin with alternate investments. Just one thing, I have done this class with this dark mode and dark theme since you guys are asking me, but I want an opinion from others also, so I'll ask all the students studying at home to give me an opinion whether this is better or they want me to revert back to the white background lectures, which is less training to the eyes basically. Anyway, so let's start with alternate investments. So very interesting topic, very interesting. So when we're looking at investments, there are broadly two ways of looking at investments. There are two modes of looking at investments. One is your traditional investments and one is your alternative forms of investments. So let's understand traditional investments, because everything that is not traditional investment is alternative forms of investments. And then we'll understand why do we need alternative investments and why is it becoming very important today. We'll discuss all these things after I'm able to explain what different alternate investments are. So firstly, when you're looking at it traditionally, so even with, in corporate trainings and all, I've asked people that, raise your hands, how many of you have put all your savings into fixed deposits? And I was surprised to know there were so many people who raised their hands. And with fixed deposits rates as low as 5.5% over here in India, you can't even expect to recover inflation. You can't even expect to keep your purchasing power parity. So it is very bad idea to put all your money in fixed deposits and all. Right? That is one. Second, when you're looking at the other alternative that I find is that people would be investing in mutual funds. That is still better. But again, the proportion of investments into equity is very low. Now it is increasing, and that is the reason why, that is one of the reasons why we've seen the stock markets increasing exponentially over the last couple of years when you're looking at 2021, 22, right? So anyways, looking at the traditional forms of investments, where would somebody invest? So if you talk about your relatives or people around you, what kind of discussions do you see? They're either doing all those provident funds, etc., because the government offers tax incentives on that, or fixed deposits and all. That is basically all fixed income securities, fixed income investments. Why is it called fixed income investments? Because the income is fixed, the rate of return, the interest rate, etc. is fixed. That is why we categorize them as fixed income. We study fixed income separately. It's altogether a different subject of study, bonds, fixed incomes and all. Next is equity. Now, I've always maintained this, that either you're a gambler or a professional trader. There is no part-time trader in between. In fact, I did a lecture on how to begin investing and all of that. I hope you people have already seen that and you people start investing. It's very important to invest in equity. The point is you need to invest over a longer term period. That is one. And second, do not be a gambler. Don't think that I will look at money control 2 or 3 times a day and I'll be able to invest. But through mutual funds, if you're not a professional fund manager or something, hire a professional fund manager. PMS, portfolio management services are available, or mutual funds and all. You can start with as low as 500 rupees. I'm not trying to advertise mutual funds and all of that, but you need to invest in stock over a longer term period. I will bring this comparison when I discuss real estate. It's very interesting chapter. So you need to invest into stocks through mutual funds, etc., or you can directly invest in stocks, at least blue chips like SDFC, L&D, etc. You can always think about it. Obviously, I'm not giving any kind of stock recommendation over here. Cash is basically, there is a part of your portfolio, part of your total fund, total money, that you keep it in the form of cash as well, in terms of medical emergencies, etc. So that you can keep it in maybe like very short-term liquid securities, your liquid debt funds and all. So you could park your money in that. So these are the traditional forms of investments wherein most of the people do invest. Of course, when I'm looking at stocks and bonds, it's publicly listed. So I do not expect you to be investing, not as in expect you to be, I do not expect the majority or the public to be investing in, let's say, a Swiggy or a Flipkart, because it is not a publicly listed company. But now we can easily invest in Zomato because it is now a public limited company. It is a listed company. Tell me, are you following this? So therefore, these are the traditional forms of investments. And why am I writing long only? Because we do not do short selling and all. You'll understand this. Sorry. So traditional forms of investments, they're long only. So we're not doing any kind of long short and all. Just give me 5 minutes and I'll explain what long short is. So these are your traditional. You're holding stocks, you're holding bonds, you're holding FDs, PFs, etc. These are all the traditional forms of investments. Anything that is not categorized under traditional forms of investments is known as alternative investments. Alternative investment is just a chapter or a subject right now, but it is a whole area of study altogether. And it is very interesting. So it is a part of finance. When we are looking at alternate investments, we have different types or different categories of alternate investments. And the point over here is, not the problem, but rather the characteristic of alternative investment over here is that within the alternative investments also, they're very, very diverse in nature. For example, the gold you hold is going to be a part of commodity. The house you live in is going to be a part of real estate. The house you live in, that you own and live in, is illiquid. You're not able to sell your house immediately whenever you feel like. There is no market price available for that. But the gold jewelry that you hold, the commodity that you hold, you can easily value that. You can sell that very easily. So basically what I'm trying to tell you is, even within the alternative investments category, the different types of alternative investments are also very different. So it is not that alternative investments, everything within the alternative investment is homogeneous. It is not that all these characteristics, all these different categories of alternative investments have similar characteristics and all. They are also very diverse. So we've categorized everything that is not traditional into alternative, but that does not mean they are all similar. Rather, they are totally and absolutely different from each other. Tell me, are you following this? Now let's go through one at a time. Let me start with real estate first. So I'll go in my order, the way I want to. So when I'm looking at real estate, the house you live in is also a real estate investment. Now you'd wonder what is the return from that. So one, you do not have to pay rent. So the house that you're living in, the rent that you're not paying is actually a part of your income and expense both. So if I'm living in my owned apartment and the rental cost is, let's say, 50,000 rupees per month. So in that case, that 50,000 rupees per month is my rental income and it is also part of my total expense because I'm living in that house. That is a way of looking at it. Even otherwise, you are the house that you're living in. When you compare, when you look at the appreciation over 10-year, 15-year, 20-year horizon, that is also a part of the return from real estate investment. The house you're living in, maybe you bought the house when it was, let's say 10 lakh rupees and today it is worth 50 lakh rupees, the house. So 40 lakh rupees is a gain that you have made by investing into that real estate. That is one way of looking at it, that I am investing in the real estate in the house that I'm living in. But obviously, suppose we ignore the house that we are living in as a part of investment. We have, and Indians particularly would always want to own their house. And I'm not sure, but even globally, people always prefer owning house. Nowadays, a lot of Excel sheets and all which will do calculations that you should not own a house, rather living on rent is cheaper and better and all of that. But I have always recommended, and I have many times recommended this book, Psychology of Money, and I hope you people have read that. So there's also an emotional angle to it. No matter how much of finance I study, no matter how much of Excel, how many Excel sheets and all I go through, but I will always want to live in my own house. I feel a certain level of peace, and you cannot quantify your happiness and your sense of peace or sense of security. So you cannot always do that. So even when you're making decisions, or say for example, you're a fund manager or a wealth manager for your client, so you have to understand that your client will also have certain emotional biases. So when we structure the portfolio now, we think about all these things. So even when you're looking at alternative investments, yes, we will study the different kinds of alternative investments, but ultimately it's a part of somebody's portfolio. There is an investor, there is an individual, there is a human being who's owning stock, bond, real estate, jewelry, commodity, everything together. He wants to have a good night's sleep. You have to design the portfolio accordingly. So we will think from different perspectives as well. So now when I'm looking at real estate, let's say I want to ignore the house I live in as a real estate investment. Even I don't look at it that way because I'm staying in my house. I don't want to categorize it as an investment. Let's say, what are the other ways of owning? So one, you can buy a flat and put it on rent. I've seen a lot of people do that. Very bad way of doing things, because normally when you're looking at investing into a flat depreciates as well. It appreciates in the beginning years, but then it also depreciates. Nobody wants to buy a flat in a 20 or 30-year-old apartment or a complex or a society. So you have to figure out that. But the problem is there are people who take commercial spaces and all and then they rent out. But the problem is that managing those real estate spaces, collecting rent, making sure that people are not, the property is not vacant and I'm getting rent for every, for the entire 12 months period. All these become a challenge. And also everybody may not have that kind of 50, 70, 80, 90 lakh rupees to invest in terms of real estate. That also becomes a problem, right? Because it is a very bulky investment. It's a very bulky investment. So there is also a way. Just the way we have something called mutual funds, we have something called real estate investment trust. That is called REIT. I'm just introducing these topics. We'll get into each of these again. But I want you to have like a bird's eye view first. So real estate investment trust. So basically what it does is, we can invest 1,000, 2,000, 5,000, whatever amount of money. It pools the entire money, let's say 100, 500, 1,000 crore. That money is used to buy different commercial IT spaces, properties, etc. across metropolitan cities, let's say Hyderabad, Pune, Bangalore, NCR and all. And that will generate hundreds of crores of rent, and that rental income will be passed on to us. It is professionally managed because 1,000 crore worth of fund if you've accumulated, obviously you can manage that professionally, hiring managers and everybody, right? Individually, if I were to buy one flat, I have to invest a huge amount of money and I have to manage that, getting brokers and doing all of the work. And also, you never know, because there is less diversification here. Because if I buy one flat, what if there is a sewage treatment plant that gets constructed next to it? Or there is a liquor shop that comes next to it? I know liquor shop might be a positive to some people and negative to some people, but normally the prices would go down when you have a liquor shop coming next to a property, because again, the environment and everything gets the security and all of these things become a challenge at times. That is the norm that we see. Now, when you're looking at all these factors, don't you see there is a lot of risk when I'm investing such a huge amount of money in one property? But through a real estate investment trust, think of it like real estate cum mutual fund. It is like a mutual fund of real estate where everybody pools in small amounts of money. That entire pool is professionally managed, invested into huge properties and all that, generates a good amount of return. So these are the ways in which we can invest in real estate. You can also take exposure by probably investing in a company like DLF or something possible and getting a little exposure. Right? So there are different ways in which you can invest into real estate. That is one asset class, part of alternative investments. Next, I want to take up commodities. Real estate, couple of more things, sorry. Real estate, it is going to be one, illiquid. If I look at buying a flat, buying a property, and then buying a piece of land and renting it out or whatever, it is going to be relatively illiquid. What do you understand by illiquid? Illiquid does not, again, people generally give very incomplete definitions of illiquid. Illiquid does not mean the inability to sell. The meaning of illiquid is, or the meaning of liquidity is, the ability to sell an asset at its fair price, again incomplete, in a short duration. Suppose I have a flat worth 50 lakh rupees. If I want to sell it at 50 lakh rupees, I'll probably take a 3 months, 6 months, 8 months period to figure out the perfect buyer who needs exactly that area, that flat, that locality and everything, and be able to sell it. If I want to sell it at 50 lakh rupees. If I have an absolute emergency, I'll probably be able to sell the flat at 40, 42 lakh rupees, 45 lakh rupees. There will be somebody who wants to jump at that opportunity, at that distressed sale. I'm in a distressful situation, that is why I'm making such a sale. So somebody wants to jump on it, makes a distressed sale, 40 lakh rupees. So you can sell the asset in a short duration, but not at the fair price, 50 lakh rupees that it deserves. So liquidity is the ability to convert an asset into cash at its fair price in a short duration. Both the things are very important. At its fair price in a short duration. Because in a short duration, you can sell at a distressed price. And you cannot sell the asset at its fair price in a short duration. You'll take longer time. So real estate is relatively an illiquid asset. REIT is not, because it trades like a share on the stock market, the real estate cum mutual fund. So I'll give you such couple of lines and all that. It will make it very easy for you to understand, to recall things. REIT is nothing but real estate cum mutual fund. Just remember it that way. Take it for the time being. Another thing I want you to understand over here is, a lot of people say that, equity markets is very risky. Nobody makes money over here, and real estate, my property prices have doubled and tripled and God knows what. The problem is that when people invest into a real estate, it is an illiquid investment. It is a long-term investment. You forget about it, or you simply sit on it for 20 years, 15 years before selling it. There are a couple of business cycles that are over in that 20-year horizon. And even if it in 10 years or 15 years, if the property has doubled, it has not given you a great return on a per annum basis. You are looking at it on a double basis, but you're not looking at the compounded annual growth rate part. When you compare the return from real estate as compared to Nifty, the broad market index in India, you will see Nifty returns have been higher, but you have to remain invested for a long-term 15-year, 20-year period. But what happens with investments into stock market is, one, you might end up investing into all penny stocks and rubbish counters based on some apparently intelligent relative of yours, or somebody who's like, I have the news, so some idiot acting like a big deal about himself. Or it is also possible that, sorry about these comments in between, but or it is also possible That, or because whenever the market is going up or going down or something, you end up selling the stocks. You're not holding on to it for a long-term period because one, it is liquid, you have the ability to sell, and two, because you can see the price every time and every day out of your office hours, you will be opening and checking your portfolio value obsessively. I've seen people doing that obsessively as well. Now the problem is your concentration is not probably so strong in terms of your work. There are days where I skip and I don't even think about checking the markets. There are working days that like that. Because I'm so engrossed with my class and work and everything that I probably don't get the time. So my class is my work, my training or my consulting, that is my full-time profession. That profession generates savings for investments. Investment is not my full-time profession. I'm not a fund manager. You have to understand that. You have to excel at what you do. That goes as investment. So understand, I'll keep on giving you ideas with respect to personal finance and all these things also. So when people say that real estate generates wealth and stock market does not, it is incorrect. You have to remain invested for a long 15-year, 20-year horizon, and then the average is going to be much better. Just because stocks are liquid does not mean you have to sell them. And again, you have to see whether you are trading on your own news and all of that, or you're investing in broader markets, or you're investing through mutual funds, or through professionally managed, in a professionally managed manner. That is what you have to see. Tell me, comfortable till here? Easy? Alright. Next, I'll discuss commodities. Now, when I'm looking at commodities, jewelry, gold is something that we Indians really like. So there was this article I was reading around 2008. So the idea was that, even if this kind of a crisis comes to India, because India, the crisis came a little later towards the end of 2008 or 2009, the market started experiencing it, if I'm not wrong. So there were articles I was going through. I remember reading that, every Indian family has so much of gold that they'll be able to take care of their expenses for at least 2 years. So maybe somebody is having a lot of gold, but their expenses are also high. Somebody may have a very small amount of gold, but their annual expense would also be lower. But depending on whatever their annual expenses are, they have a decent amount of gold to take care of a couple of years. I'm not promoting or saying that gold is something that you should invest in. I'm just giving you an example of what it is. So when you're looking at commodities, the first one that comes to our mind is gold, which is generally held by us in the form of jewelry. But now we don't even have to hold physical gold. We have sovereign gold bond, where the government is paying us 2% or so interest as well, 2.5% interest as well. I also invested in that. And you have ETFs also. So you can hold gold in the electronic form. So there is no safety issue, insurance issue, etc. And it is very easy to hold gold that way. And there is no liquidity cost and all of that. I don't know if you people know, but when you go to sell jewelry to the same jeweler from whom you had purchased, making charges gone to waste. Their bid ask rate is separate. So if you are able to buy gold at 40,000 or 45,000, you'll be able to sell it at 40,000. The spread is quite huge. The spread is quite huge. And then they will say, no, there is a little bit of quality issue, and this is this much carat gold, and this is this much carat gold and all that. Ultimately, you're not going to get a fair price for your jewelry. So just saying that, instead of holding gold in the form of ETFs or in the form of electronic assets, I want to hold it in the form of jewelry. At least I'll be able to wear it. So don't fool anybody. And again, understand. So then, there are a lot of ways of looking at things. So I have seen and I have talked to people who have started saying that, gold is a bad investment, jewelry is a bad investment. I'm not commenting right now on gold. But jewelry from the point of view of it, so, jewelry is like an ultimate emergency cash. Don't even count jewelry as investments. Again, these are the things that you read, the more you look at things from a more human perspective and not from a very formula perspective. You understand that, when you're looking at these gold investments in the form of jewelry, of course, I'm not in favor of it. But the point is that it is an emergency cash. Jewelry is one of the last things you're going to sell in case of an exceptionally bad medical, whatever. When you don't have anything left, you're ultimately going to resort to gold jewelry. And they are passed on from generation to generation. So it kind of creates wealth in the very, 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 very long-term way. Business cycles might be 10 years, commodity cycles are even longer. So when you're looking at gold maybe for the 5 years or 10 years, you may not like it. But when you're looking at it for a 20-year horizon, you may like it a bit. Right? And again, why do we invest in gold? I hope you have studied something called covariance. So the idea of investing in gold is also that whenever the stock market goes up, gold is generally not increasing, but when the stock market goes down, gold increases. We have seen a negative correlation between stock market and gold, equity markets and gold. So what happens is they balance out each other and they reduce the risk. So in order to diversify the portfolio, we want to add gold, because when the stock market is down, gold goes up. So there is a little bit of balancing. Instead of two stocks, I will cover this, we discuss this in portfolio and all in detail. So the idea is when two stocks go up and go down together, the portfolio moves this way. Just understand the basics right now. And if two stocks or investments move in opposite direction, then they balance out, the positive and the negative balance out each other, and then the portfolio, the total moves in a narrow direction. This is more risky or this is more risky? This one? So I want diversification. I want to invest in asset classes which are negatively correlated, where one increases, the other decreases. Tell me, are you following this? So that is also one of the reasons why people invest in gold. Another one would be silver. Silver, again, you have to use physical silver and all, otherwise you have futures available. So there is something that you will study called derivatives. So once you study derivatives, you will understand how to deal in commodities, because what happens is in commodities we also have oil. You have different kinds of commodities. You have precious metals, gold, silver, etc. You have oil and all. Then you have agro-based commodities. You have wheat, rice, etc. Corn and all. And now obviously if I want to invest in oil, I cannot bring oil a drum to my house and keep it and then sell it after a year or 2 years. That is not possible. So what do? You bet on the prices of commodities through derivatives. So there is something called derivatives which you will study altogether separately. It's a different subject altogether. So once you study derivatives, you'll have a better understanding as to how to deal in commodities. You can just think of it that I am saying that today, let's say the oil prices are, let's say $110 per barrel. In 1 year, I am saying that, okay, after 1 year, I will buy oil from you at $110 per barrel, or let's say $120 per barrel. After 1 year, if the price is 140, I still have oil at 120. Basically, you're betting, you're basically contracting. So again, I'll be able to discuss this and explain this only once I've done derivatives. So commodities, because we are not always going to be able to keep it physically in our place, at our place, so you'll have to invest through something called derivatives. Let's leave it at that. The other ways could be investing through companies like a Coal India or something. So I can get exposure to coal. I can invest in very commodity centric companies, companies whose total valuation is being driven by the commodity, Nalco, Balco, etc. So I could look at that, oil companies. So that is one way of investing into commodities, right? Now commodities could be relatively more liquid. Their market prices could be available. Real estate, you cannot open money control and see the price every day. But in case of stocks, you can. You're understanding the psychology aspect as well of the investors. So these are these two. Next, since I've discussed real estate, let me do these farmland, timberland and infrastructure quickly first. So now there are different ways in which you can invest into real assets. So when I'm looking at real estate, basically I can categorize this real estate, farm, timberland and infrastructure into maybe real assets. Now what happens is, when I'm looking at farmland, nowadays people have started wanting to invest into something called farmland. They want to have a farmhouse and a huge piece of land parcel where they're growing crops, etc., selling that. Organic farming has become quite this thing. So it is so stupid of us to play with nature the way it is, because earlier we started with green revolution and hybrid and all, using all chemicals and all that, and now we are again going back to the original farming, that is organic farming. That is what we are trying to do now. So when you're looking at organic farming, so people want to generate revenue out of that, and also because agricultural income is not taxable, so people try to take advantage of the taxation aspects as well. So that is one of the reasons why farmland could be useful. Third, investing in land, because the land parcel that you have right now, what if a highway gets constructed over there? What if 100 smart cities is being done, and what if there's an airport that comes near you, near your farmland or something? The property prices, the land prices are going to skyrocket. So farmland investment could be maybe because you want to invest in land, maybe because you want a farmhouse where you can probably, in lockdowns kind of situation where you can probably relax and rejuvenate or whatever, and at the same time generating agricultural income on the side. Are you understanding? Next is timberland. Timberland is primarily for timber. So I knew this guys, so there was this neighbor of mine, so they had this huge land parcel which was owned somewhere, I don't remember which place, but they were growing eucalyptus trees over there. The idea was that it was a piece of land, forest land, or I think obviously it must have been approved and all those legal aspects and all taken care of. Okay, I wanted to make a sarcastic comment over here and I'm thinking whether to make it or not. So there is one of the authors who won Booker Prize winning Booker Prize, and unfortunately I read her book, and she is did a lot of activism and everything around environment and this and that and against the government and all. And she herself has built a bungalow and farmhouse and everything in a forest land which is not supposed to be. And this hypocritical whatever is, I don't know what to say. So there are people investing into farmland like these as well. And they apparently, anyways, forget it. So coming back to timberland. So when you're looking at eucalyptus trees and all, so the idea is that 10 years, 15 years, I'm going to be growing those timberland, growing those trees and everything. And I will harvest that and sell that timber. And that is my return. But it is a very, very long-term return. Over a 10-year, 15-year, 20-year kind of period, you are going to be able to generate that return. But along with that, you also have the land parcel with you. It is possible that there are environmental, etc. regulations that you can cut down the timbers, the trees and all, but you'll have to reforest them. So it is possible that the land cannot be used for anything else. It is also possible the government keeps on converting forest land and all these things into commercial spaces and all. That could be a possibility, but may not be. So you'll have to evaluate and then invest into timberland. Third is infrastructure. One of the best examples I could give you is airports. So the government is entering into a lot of even ports, shipping ports and all, entering into a lot of public-private partnership, because the government again cannot spend all the money. Also, again, that's another discussion, but the financials are pretty bad, obviously, with the COVID and the COVID bailout and everything, whatever is happening, the debt to GDP ratio not being that great. Anyways, even in Singapore, even in other countries, there is a lot of public-private partnership model that works, a PPP model. So infrastructure, what happens is private companies invest into airports and all. Jawar Airport, I was doing valuation for some reason for this Jawar Airport, or I was helping somebody doing that, I don't remember. So basically the idea is that in these many years, this percentage of airport will be done per passenger. What is the income that the airport will generate? Because you've invested in a huge infrastructure. So airlines also, even when you book an airline ticket, you would notice that there is an airport development and all fee and everything. So the airline, Indigo or SpiceJet, is not going to get the entire fee of yours, the entire airline tickets revenue, that the amount that you pay. There is a portion of tax, there is a portion that the airport authority is going to get, and there is a portion that the airline company is going to get. Indigo would also have to pay rental, etc. for using the airport, because they land the flight over there, they take off from there, they're using the entire facility and all. So these infrastructures, private companies could enter into these infrastructure projects. GMR Infra is one of the companies. Adani, of course, is there into this and buying almost everything out there in terms of ports and this. So when you're looking at airports, ports and all, so infrastructure is a PPP investment where, and generally what happens is towards the end of, let's say, after 20 or 40 or 50-year period, the entire airport is going to be the ownership of government. So when you do valuations and calculations also, you do it in such a way that my investment into getting that airport done and all, I will be able to recover my investment and a good amount of return in the 30 years or 40 years. Then the entire property becomes a part of the government's asset, right? So we have a lot of PPP model infrastructure and all. Even if you heard Nitin Gadkari talk about it, so this guy talks sense apparently. So again, that's my opinion. I don't know if I'm allowed to be saying all these things or not, but he's good. I mean, I actually was commending him. So with respect to highways and also, he wants to collect tolls and all. Then so basically with the tolls, the same. Traffic and everything, then we've got this mandatory, what do you call that? FASTag and all that system is there. So now it gets deducted automatically. There is no traffic issue and all. And because there's so much of money that has been invested into NHA, into highways and all construction, obviously he's saying that I will not do away with the tolls. I will keep the tolls, because if you're using the highways and all, you ought to pay. So there were proposals that, you should not be charging people to use highways and all. People are not being charged to use roads in the city. But if you're conducting business and commerce, you have to pay for the use of highways and all. And you have to understand, the moment highways and all are built, there was a highway built, I remember this lady near her house, she worked really hard to get that house and that parcel of land and everything. And the moment a highway came, the price of her land from 2 lakh rupees went up to 10 lakh rupees just because of that one highway. I don't know if you people know about it. When the Singur project, Tata Nano project, was supposed to come around the Singur land area, the entire highway, the entire stretch, the property prices went up like anything. So whenever there is an infrastructural project or something that comes up, it becomes very, very, the land prices increase. So there is value creation. Without actually doing anything, as in, without actually constructing anything on your land, your prices increase. That is why construction of infrastructure, roads, airports, trains, etc., railways, etc., is very, very important. So that is your infrastructure part of it. Tell me, comfortable over here? Next, I'll discuss private equity and private debt. So private equity, basically, today I cannot invest in Swiggy, but I can invest in Zomato. Zomato is listed on the stock market. It is listed on the stock exchange. So I am able to invest in Zomato. You can invest in Paytm today, but you cannot invest in PhonePe, right? Because PhonePe is privately owned. It is not publicly owned. The shares are not being traded between us. I can just simply open any of the Zerodha or whatever app I have. I can easily buy ITC's shares because it is a publicly traded stock, publicly owned stock. People are there in the marketplace where lakhs and lakhs of people are willing to buy or sell the stock at any point of time. But in case of Flipkart or a PhonePe or a Swiggy, it is a privately owned company. So private equity is where you want to make investment into private equity. Equity shares, you want to gain ownership, you want to buy a certain percentage of ownership in privately of a company into a company which is not privately available, not publicly listed, not listed on the stock market, on the exchange where we all can trade it amongst ourselves. That is the reason why I said that traditional forms of investments will include stock and bond, public, not private. Tell me, comfortable? Now when I'm looking at private equity. So private equity, I'll be looking at it in broadly two broad categories. One is your venture capital and one is your leveraged buyout. So what is venture capital? Venture capital is basically your startups. So when you're looking at these new startups, new companies in which people have invested. So somebody must have invested in Swiggy long back. Obviously they must have invested at a very smaller price compared to what the valuations are today. When you're looking at Swiggy or any of these number of unicorns that we have, Udan for example, right? So when you're looking at these startups, so venture capital, in case of startups, generally you are ending up investing into the equity side of it because nobody wants to loan out to a startup because the risk is too high. So, and normally when you're looking at these investors, so we have something called private equity funds. So what happens is there are large investors because private equity funds, they will not accept 10,000, 15,000, 20,000 rupees from somebody like me. They would want a minimum investment of, let's say, $1 million. Or 1 crore rupees. The ticket size is very, very high. It's very, very large. So they have a very large ticket size. So it's generally the high net worth individuals or ultra high net worth individuals, UHNIs, that end up investing into these PE funds. So PE fund, let's say people have put together a fund of, let's say, a $50 million or $100 million or an $80 million. Maybe a group of 10, 15 investors have put together that money. There is also going to be a general partner. We'll discuss these terminologies later in detail. So there is a fund, and now that fund is being managed by a professional manager. We'll call him a general partner. We'll discuss the general partner and everything later. So investors are pooling in the fund, and there is one guy who's going to be managing all the investments. He is going to be selecting a portfolio of startups. He'll not be investing in one startup because you know that 90% of the startups fail in the first 3 years of its inception. I want to invest in multiple startups. And there could be PE fund which specializes into tech startups, one into biotech startups, pharma startups and all. So we are going to be looking at, let's say, a PE fund which is pooling in money from large investors and they're going to be investing into these venture capital. So that is private equity investment because they're investing into private equity, not publicly listed equity. And PE funds could be investing at different stages. There are PE funds who would be investing at maybe 10 lakh rupees, 15 lakh rupees, 20 lakh rupees kind of money, maybe at a very, very early stage, seed stage of a startup. There could be people who would be investing only after a couple of series of funding is done, only then a relatively matured startup. I will invest into a startup when they have certain level of market or something determined, and then they want money for expansion, let's say. They have some established product, prototype, etc. in the market, some kind of sales they already have, and now in order to take it to the next level, they need money. So there could be different PE funds, different kind of funds who are investing at different levels or stages of startups. Obviously, the risk is very high when you invest very early, but then the return could also be very, very high because you would be getting stake at a very low valuation, right? So startup space, your VC space is one part of private equity. Also, what happens is, at times, there is something called a leveraged buyout. In LBO, what happens is, say suppose, take a company, let's say Jet Airways. So Jet Airways, let's assume that at that point of time, Jet Airways was in a really bad situation. Jet Airways was not being managed properly. Let's think that a private equity fund is there and they think that I can buy Jet Airways because the valuation went down like crazy because of the defaults and everything. What if they think that PE fund thinks that, let me buy Jet Airways, let me convert it into a private company. There is no public company now, there is no trading and all happening. Let me work on it for 3-4 years, hire a couple of people from Indigo, etc. Revamp the entire company, manage the cash and everything of the company very well, run the business very well, make it into a profitable business, and again relist it on the market. So maybe I'm buying it out at 10 rupees per share and I relist it at 100 rupees per share. So let me make it a turnaround strategy. So basically in a leveraged buyout, leveraged means where you have taken a huge amount of loan. Leveraged, your position is leveraged. Buyout is there is an existing company. So you will buy an existing company which according to you, you can manage it better, operationally better, or you can do something where you can revamp the company in a much better way. So you will buy out a company, very often a listed company, you will buy it out, convert it into private. You have bought out, you have bought 100% shares, 90% shares, whatever. Now you have the ownership and control of the company. You will work around it for 2, 3, 4 years, revamp the company. Obviously, you have to make sure that the company is producing good amount of cash flows because it's a leveraged buyout. You've taken a huge amount of loan. Obviously, to buy a private company, you'll anyways need a huge amount of loan. So because you've taken a huge amount of loan, you need to generate a good amount of cash flow so as to pay for those, the debt that you have raised, the loan that you have taken. So leveraged buyout is you buy a public company by taking a huge amount of loan, convert it into private, make it a turnaround strategy and relaunch it in a few years time frame. Let's say if a private equity investor who's invested in Tesla wants to do it for General Motors or a Ford, what if they want to do that? Of course, you need huge amount of money in order to convert a public company into private. Do you understand the stark difference between an LBO and a VC? A VC invests in a very new kind of business, startup, new business, no existing cash flow, and I'm investing in equity. But in leveraged buyout, you need a company which is already existing into business. It is a huge business, a public business. You will make it private and it has to start generating cash flow in year 1 or year 2 itself because you've taken huge loans to buy this company. But in VC, you don't expect it to generate cash flow for the next 5-7 years. ATM, we still don't expect when it is going to be making profit, or Zomato for that matter. Tell me, are you following this? So private equity is private investment, privately owning equity of a company. In VC, it's new businesses, startups, etc. In LBO, it is buying by taking a huge amount of loan, converting a public into a private company, where you think you can revamp and do something really great. Private debt, similar to private equity. Now I can subscribe to bonds or debt. I know bond markets or debt market is not very, very liquid and very, very evolved, not only in India but even otherwise. I remember getting a mail, I discussed this in some class. Mahindra was issuing some bonds and also minimum, the multiple was 1 lakh. Each bond is 1 lakh rupees. So either you invest 1 lakh or 2 lakh or 3 lakh. So you can buy bonds like that and it was giving some 8.75% return and so. That is public debt because that is being issued to public. But still the bond market is relatively illiquid in India. But still you can have public debt. When you're giving loan to a company privately, that is private debt. That is not listed. You cannot just sell loans amongst yourselves. You cannot just sell bonds. Bonds people can buy and sell with each other. Liquidity might be low. It might be difficult to buy and sell, but we can. In case of private debt, an example could be distressed debt. So what happens is at times when the company is not doing very well, let's say for example cafe coffee day. So, but you think that even if I sell the assets of the company and everything, I'll be able to recover more amount of money than what it is trading right now because people reacted so much, people overreacted, people got so scared, they sold off, the prices went down like crazy. So even if I sell the company, I'll get 40 rupees a bond, but the bond is trading at 30 rupees in the market. So what I will do at 30 rupees, let me buy all the debt, invest privately into the debt, and then slowly I'll start selling all the assets of the company and I'll recover 40, or I'll restructure the company, revamp the company, and when the company starts running okay, I'll be able to make a good amount of fortune. So that is distressed debt. So one of the investments of private debt could be in the form of distressed debt. Not very important, just private debt. So privately investing in loans or something of a company. Last one is hedge funds that we are going to discuss. Now hedge funds is basically in a very short manner, if I could say, Amir Log Ka mutual fund, rich people's mutual fund. How does that work? So now what happens is, when you're looking at equity and all, in stock market, most of the mutual funds would be earning in the range of, let's say, 12, 13, 14, 15. But everybody is ranging between 12, 13, 14, 15% kind of return. I'm talking about mid cap, large caps and all. Now what happens is, there are certain individuals who have a lot of money. They have family offices and all of that. They have, let's say, thousands of crores to invest. Let's say Ambani's kids. They would be having a huge amount of money, depending on which Ambani you're talking about, though. But anyways, the point is that when you're looking at, even otherwise, both would be having a huge amount of money. So there's a lot of ways you park your money, you take your money out and do a lot of things. But anyways, when you're looking at that huge amounts of money that some investors could be having, they might want to take a lot of risk in order to generate a lot of return. Because in the public markets, so everybody is investing. Now, because everybody's money is being invested in these public markets, mutual funds have a lot of restrictions and regulation. You have the Mutual Fund Association and all regulating that. Why? Because when people in public as in people, common people like us, when we are investing in the markets, we cannot afford to lose our money. Mutual funds cannot just take risk and gamble with our money. There is a lot of restriction with mutual funds and all. Because we cannot lose faith in the financial markets. Understand, only if investments in our market will grow, the economy grows, the government would want that public's money is safe, especially the common public who have small amounts of money and they cannot afford to lose that money, their savings and all, right? Finance is very important. There are so many farmer suicides that take place purely for financial reasons, because of financial reasons. So do not undermine the importance of finance and the ethics, the importance of ethics in finance. Tell me your understanding. So now what happens is, mutual funds cannot take risk and therefore they cannot probably generate extraordinary returns. Mutual funds can buy stocks, they cannot do short selling. Short selling is basically, if I were to give you in a very, very quick manner, so suppose I do not own a stock. Let's say there is a stock X and I think it is going to go down. If I don't own a stock, what can you do about it? You can't do anything. In short selling, what happens is, suppose you have that stock, I'm going to borrow, let's say that's 1 lakh stocks from you, 1 lakh shares from you. I will sell it in the market at this price. When the price reduces, I will buy back those 1 lakh shares at a lower price and give it back to you. I'm borrowing shares from you. I'll have to return back shares to you. If the price falls, I make this profit because I'm selling here and I'm buying here. Tell me, following? But if the price increases, I'll have to buy over here and give it back to you. I will end up making losses. Government cannot allow mutual funds and all to do all this stuff. If mutual fund gets 100 rupees, they can invest 100 rupees. But in case of a hedge fund, if you get 100 rupees, you can borrow 90 rupees and invest 190 rupees also. Because hedge funds, basically hedge funds are not allowed to advertise. You can see mutual fund advertisements on the webs, on CNBC and all the time. Mutual fund sahi hai. But there will be a small disclaimer, invest करने के पहले दस्तावेज जांच ले, right? Markets are subject to market, investments are subject to market risk, and all read the offer documents carefully before investing. So those disclaimers are there. But mutual funds can advertise. Hedge funds cannot advertise because we don't want common public बेवकूफ बने. We've had too much of sarda varda and all. Now we don't want the common public to be losing their money. That is one. Second, the regulations are very low on hedge funds. They're allowed to do whatever they feel like. Mutual funds very heavily regulated. Hedge funds do not have a regulation. You can do short selling, you can borrow, you can use derivatives, you can do a lot of things. Who can invest? Minimum ticket size is very huge. Let's say $1 million. So only somebody who has a huge portfolio and a good understanding of finance and has the ability to take risk, only those people will be able to invest into hedge funds. That is why I told you rich people's mutual fund, think of it that way. Not too much of regulation, not too much of disclosures. Mutual funds have to disclose. A mutual fund, whatever shares they're holding, they'll have to give a disclosure. You go to their website and you will be able to see. Hedge funds don't have to disclose. They can do whatever kind of strategies they feel like, but they cannot market. Common public बेवकूफ नहीं बनना चाहिए. We cannot fool the common public and their money because the government has a responsibility in terms of safeguarding our finances. That is hedge funds. And even within hedge funds, there are a variety of strategies. There could be one hedge fund whose strategy is investing in different countries. So I will see, okay, India is doing better right now, let me put my money over here. Achha, China is doing badly, let me take out my money over here and invest into Vietnam. Or let me invest into Taiwan. So I'll take my money out of China and I'll invest my entire money into Taiwan. So I will be doing these kind of investments and all. I don't know if you people are understanding all the things that I say. So anyways, the point is that you're going to be, that is a global macro strategy. where you're investing in different countries and all, based on the GDP of the country, the political situation, the social situation, the demographic. Everybody wants to invest in India because we have a young population and we are a consumption hub now looking forward, right? There could be a strategy which is, let's say, a hedge fund strategy that is a merger arbitrage strategy. So basically it will figure out, let's say company X wants to acquire company Y. So whether X will acquire Y or not acquire Y, you will study that. Like right now, Amazon, Aditya Birla Group and Reliance was having some issue. Future Group, these three. So what will be the outcome? He will win or he will win? If he will win, I will buy his stock and sell his stock. So you will analyze the regulation. You will analyze what the court should say. You will analyze the entire situation and everything and you will bet on it. Event-driven strategies. Whether this will happen or not happen. Whether this merger will happen or not happen. Whether this case will take, whether this merger will be allowed by the government or not allowed. Are you understanding? So these kind of event-driven strategies could be there. There could be a long-short strategy, where, for example, you think that banking sector is going to be outperforming, let's say, कौन सा sector? Let's say metal sector. No, metal sector will outperform FMCG. So metal will outperform FMCG. So your strategy will be buy metal, short FMCG. So I have 100 rupees of money with me. Let's say hedge fund has got 100 rupees. What they will do is they will sell 100 rupees worth of metal, worth of FMCG and invest 200 rupees in FMCG, in metal. So 100 they will short. So if I have my 100 rupees, I will short sell 100 rupees with FMCG and the 200 rupees I'm going to invest in into metal. These are not allowed for mutual fund. They cannot leverage, they cannot use derivatives. You'll study derivatives in a separate subject. They cannot do the short selling thing. They cannot do all these kind of things. But hedge funds are allowed to do that. Why do they do that? So that they're able to generate a good amount of profit, good amount of return. Tell me, are you following this? Comfortable? Sure. So these are the variety of alternative investments. Even if you look at paintings, or those rare coins and all, they are also actually a part of of alternative investments. People do invest in those paintings and coins and all of that, stamps, etc. So that is all going to be a part of alternative investments. So anything that is not categorized under traditional investments is known as alternative investments. Tell me, comfortable till here? Understanding broadly what these variety of investments are? Now we need to understand the different characteristics of alternate investments. One second. Alright, let's continue. So basically when we're looking at the characteristics of alternate investment class, you'll have to understand, as I told you, that within the alternate investment class we have so many segments, so many asset classes, if I could say, or assets, real estate, commodity, farmland, timberland, etc. And they're very diverse. They're not homogeneous. So when I'm looking at these characteristics, they're broadly the characteristics of alternate investments, but they may not apply to every single category of alternate investments. So please understand that. Let's say the first one, less liquidity. We've understood the meaning of liquidity. Liquidity is the ability to sell an asset, convert an asset into cash at its fair price in a short duration of time. Convert an asset into cash at its fair price in a short duration of time, right? That is liquidity. So alternate investments ideally, normally are going to be less liquid. So when I'm looking at real estate, a farmland, a timberland, you cannot just sell a piece of land to somebody else tomorrow. It takes a lot of time, brokers, etc. You'll have to involve people, figure out a buyer and everything. Even when I'm looking at a private equity investment, do you think somebody can sell Flipkart shares very easily? So somebody has 5%, 10% stake in Flipkart, not shares as in shares in the market, but they'll have a stake. They cannot just immediately sell it to anybody they want. They'll have to figure out another PE fund or somebody who's willing to invest and buy, and that kind of money they would have, right? Less liquid. But the moment I look at gold, it is very, very liquid. The moment I look at REIT, Real Estate Investment Trust, mutual fund of real estate, that will be very, very liquid. So depending on the kind of alternate investment it is, it will be liquid or illiquid. But normally if I look at the alternative investment asset class, it is going to be relatively less liquid in nature. Tell me, are you understanding this? Got this? We look at individually real estate, hedge fund, private equity, everything. I want you to have an overall picture and idea about alternative investments first. Second is specialized managers. Now specialized managers, basically what happens is, when I'm looking at mutual funds, large cap mutual funds investing in broadly the same 10-15 stocks out of the same 50 stocks of Nifty, let's say. So there is not so much of specialization left to do over there. For example, when you're looking at real estate, you'll have to understand the vacancy, the regulations, the brokerages, the investing into real estate, the geographic area, everything. You need a specialized manager who can understand real estate and real estate valuations and real estate rentals and all. In real estate also there are REITs, there are real estate investment funds and all who invest in hotel properties, who invest in warehouses, who invest in malls. Malls and all are huge investments. So when you're looking at real estate, you need a specialized manager who understands all of that. You have RERA regulations, etc. for real estate. When you're looking at, say for example, paintings. So I don't know if you people have seen white collar, probably there is a lot of paintings and painting forgery and everything happening, and there are painting curators and all who visit museums, who curate art, who purchase art for these ultra HNIs. So having an eye for detail, having an understanding of which painting could do good, which painting may not do well, which painter would be very famous or successful or something, which painting should I invest in. It's a very specialized kind of a way of looking at it. Private equity, the way you look at stocks, when I'm looking at an ITC, an HUL or something, most of the data is publicly available. Analyzing those companies is very different as compared to investing into venture capital. You might be inclined towards investing into a Paytm, Zomato now, but 10 years back or 5 years back when these companies actually started, did you know that these are going to become these unicorns and these huge and this huge? No. So analyzing a venture capital, investing into a startups is an absolutely different ballgame altogether as compared to investing into publicly listed entities. So you need specialized managers who are investing into these alternative classes. Hedge funds, they are taking a lot of risk. A mutual fund manager would not be able to do a very good job at a hedge fund unless he's trained and gets into it. There are different strategies. When you're looking at a global macro, a fund manager in India would be looking at, a fund manager in India also would be having a sector expertise. So maybe he's covering the banking sector. But when you're looking at a global macro hedge fund strategy, so you'll have to see how the politics is, how the GDP of the countries are, and what is the relationship between countries and all. I had recommended this book, Breakout Nations by Ruchir Sharma, to understand the geopolitical, socio-economic kind of a understanding between different countries. So he was the emerging fund manager for Morgan Stanley. He retired just a while back. So when you understand that what are the equations between countries, what kind of trade restrictions and regulations and all they have between the countries and all, what is the inflation interest rate in the country, so which country should I invest in, which country should I take my money out from, so all these things are important. So you need specialized managers, because within the alternate investment category also everything is, the sectors are very, very diverse, the categories are very, very diverse. Tell me, are you understanding this? So specialized managers. Another thing is they need to be active managers. What is active versus passive investment? Passive investment is, say for example, I have purchased, let's say Nifty or let's say a mutual fund and I'm sitting on it for 10 years. I have invested in the 50 stocks of Nifty and ETF. You'll study ETF and all these things later. Let's say I have invested in Nifty, the 50 stocks, the 50 top companies of the country. I have invested in those 50 companies together and I am going to simply keep it for 10 years. I will not churn it too much. There is not too much of buying, selling. Okay, this is undervalued today, let me buy. Okay, this price is increased, let me sell. That is passive. Passive, not doing too much. Invested, keep calm and relax and keep evaluating. So every year maybe if there is any difference or any change or something, then you rebalance a little bit. But it's not that continuously you're monitoring and changing and rebalancing your portfolio and buying, selling and all of that. But in case of alternative investments, you have to keep a track. Most of it is going to be actively managed. For example, even when you're looking at the private equity space, there are funds at times, one PE fund bought this startup, now this PE fund has bought this startup. So the PE fund that is owning Flipkart will also own Myntra, so that they can create synergies by combining the two companies together and associating the two companies together. So all these things happen. A lot of M&A goes on in VC space also, mergers acquisition activities goes on nowadays in the venture capital space also, in the startup space. Like Facebook acquired WhatsApp and Instagram at a very, very large scale, at a very, very high level. So there is a lot of active management required. You need to be updated as well with respect to what is happening. Hedge fund strategies, you're using leverage and all of that. So a lot of active management is required. For example, you took a public company private. You'll have to manage, obviously that public company was not being managed properly. The whole idea was I'll take a huge loan, buy that company so that I can revamp the company and get it back listed. So in that revamping process, you'll have to be involved. There is active management involved in these kind of investments and all. That is second. Third is less regulation. I told you mutual funds are heavily regulated because the government cannot allow that common people like us end up losing money. They regulate that, right? The government wants us to be included in the financial growth of our country, right? Jan Dhan scheme, the banks, the investments in markets and all. And our investments are still at a very low stage. When you look at the percentage of people who are involved in the amount of money that domestic investors invest in their country, in India, we are still at a very low level. There is, I think, how many crore demat accounts? I'm not being able to recall the exact figure, but it's in a single digit figure in a population as large as ours, exorbitantly large as ours. So less regulation. In hedge funds, mutual funds and all are not less regulated, but in hedge funds there is regulation. You don't have so much of regulation in terms of timberland, farmland, etc. You have your regular RERA and all, but not very heavily regulated like SEBI. So SEBI regulates the entire stock market, Stock Exchange Board of India. Association of Mutual Fund of India, AMFI, that is regulating the funds. But you don't have that kind of regulation and disclosure, transparency also for hedge funds. Stock market, you can see the price immediately. But will you be able to see the price of your land or your flat or your painting or your private equity? Will you be able to get a continuous price with respect to Flipkart? The kind of disclosures that Zomato has to give because it is listed, because we public can invest. You will not find that kind of disclosure available for Swiggy at all. Tell me, are you following this? So less transparency and if it is less transparency, again need specialized manager. We don't have that much information. There is major information asymmetry. There is not too much of publicly available data using which I can analyze. So specialized managers are needed in order to do that. Low correlation, most important, one of the most important factors is low correlation. That is the reason why I want to invest in alternate investments. Because as I was telling you that if two stocks move in the same direction, correlation is high. Together, let's say equity and gold, I'm investing into equity and gold. If both of them would have moved high, my portfolio would be moving this way. But if they are increasing and decreasing in the opposite direction, in that case they balance out each other and my portfolio moves in a narrow range. So therefore, I am in an advantageous position. I want low correlation. That is the reason why we say do not put all your eggs in one basket. Do not depend on single source of income. Do not put all your money in one industry, one sector. So that if one sector is doing bad, the other one might take it up, might cover up for it. If one form of investment has gone bad or has generated a lot of losses, there will be another one that is at least taking care of a chunk of returns. That is why low correlation is very important, and alternate investments, because they're very different from the traditional forms of investment, it becomes very useful. I'll give you another example. So when you're looking at equity, if there is high inflation, normally equity is suffering and even bonds suffer. Because if inflation is high, interest rates are high. If interest rates are high, discount rates are high. If discount rates are high, valuation goes down because you're discounting future cash flows to value equity. See, you will have a little bit of trouble at the beginning because there is a little bit of equity I'm discussing, a little bit of fixed income I'm discussing, a little bit of quants I'm discussing. But even when I'm doing equity, there'll be a little bit of corporate finance I'm discussing. So at the very beginning stage of finance, these issues will happen because there's a lot of connections between different subjects. But by the end of the entire basics of covering, different subjects, you'll be very, very happy in terms of understanding and relating all the subjects together. And I like to relate subjects so that you have a more macro level holistic understanding. So coming back to it, what was I talking about? Low correlation. So when I was looking at the valuation, so equity, bond and all, when inflation is high, inflation high means what? Mehengai, things are getting expensive. At that point of time, equity, bonds, etc., valuation will go down because the value of anything is PV of future cash flows. I'm assuming you've done time value of money. So the value of anything, if interest rate goes up, if discounting rate goes up, the value goes down. But when inflation is high, commodity prices go up. So when your equity market is falling, commodities might take care of it. Tell me, are you understanding this? So that low correlation is important so that they're balancing out each other and I'm having a good portfolio. When you do portfolio, you'll understand low correlation is important because I want a higher Sharpe ratio. If you've covered Sharpe already, we'll discuss Sharpe ratio later. Forget about that. Next is here, but the low correlation may increase. Now understand that I'm calculating correlation. How do I do that? I have a column of X, I have a column of Y. I'll do covariance X, Y, sigma X, sigma Y and all. I'll calculate correlation. Okay. problem is that when you're calculating correlation, maybe I've used the last, let's say 1 year's data, 250 or 200 trading days data, 200 days data, 100 days, so I say it's going to go with this weekends only, 250 days trading data, sorry. So 100 days is your weekends, 100 for 365 minus 100 for another 10, 15 for your holidays. So 250 days or 240 days trading data we are taking. So I'm basing my today's correlation. I've used last 240 days worth of data to calculate correlation today. Okay? Now say for example you're standing on, let's say, 1st of April 2020. So COVID has happened. People have started understanding what it is. They've just started, lockdowns have started and everything is happening. Let's say end of March, first week of April 2020. Now in that kind of a situation, do you think that last 1 year's data is representative of how things will move and how the relationship between the two asset classes are? Because there was no COVID in the last 240 days of trading data, but now you have COVID. So correlations is not something that is constant. How do you calculate these averages and standard deviations and all of that? Looking at past data, but the past data is not guaranteed, or it's not mandatory that past data will be what it is today. Things might change. Economy things might change. There might be an economic event, a paradigm shift in the economy, a regime shift in the economy. There might be some factor that has changed, which is kind of creating a demarcation. 91 liberalization policy was there, so liberalization happened in 1991. So you cannot say that 1991, the day India's correlation with the entire world increased after the liberalization, because India opened the economy to the world. Earlier it was more of a segmented. India was a cocoon; it was separate, but now it opened to the world. So therefore, the correlation with the world economy increased. You can't say 1991 that 5 years past data ka correlation is low, so my correlation is very low. You're understanding what I'm saying? Correlations do increase, and they increase in stressful times. Normally we say that everything is going wrong together. Good things don't happen together, but bad things do happen together. Correlations increase in stressful times. Musibat aata to ek charo taraf se aata hai, and all these things we say na. Contagion. So basically correlation. So when do you need this balancing? I'm happy if two stocks go up together. I'm sad if two stocks go down together. So I want a high correlation when stock goes up. But what happens is correlation increase when the two stocks are going down, when the market is in a turmoil, when there is stress. Because whenever there is stress, it trickles down to different sectors. People react, people sell, people overreact. Correlation increases in stressful times. You invested into alternative investment category because you were assuming that correlations are low, I will get benefit of diversification. The returns will balance out each other. My traditional finance ka returns, investments, and my alternative form ka returns. I'll have to change this setting or something. Got it? But it does increase in stressful times. So we'll have to be at least cautious. I'm not saying that we're not going to be investing into real alternate form of investments, but we need to know about it. Normally we have seen that hedge funds, because hedge funds do long short strategy and all. So hedge funds outperform equity when markets are very bad, because they are kind of neutral. So we'll study, when we study a lot of hedge fund strategies, you'll understand this. Because I'm buying one bank and I'm selling one bank because I think this will do better, this will do bad. But net, I am indifferent to the banking sector. We'll do hedge fund strategies, very interesting. Okay? So this is your low correlation, but correlations might increase, and especially during stressful times. Next is your high management and incentive fees. Alright, so one, we've understood specialized managers are required. If somebody is having specialized skills, will they be asking for more money or less money? More money. So high management and incentive fees. Let me give you another example. When you're looking at equity fund managers and all, let's say on an average, suppose there are 100 managers. The top 25 managers or the top quartile managers, they on an average are earning, let's say 18%. Okay? So let's say there are 100 equity managers. The top 25% managers or the top 25 managers or the top quartile managers are earning, let's say 18%. The bottom 25, the bottom quartile is earning, let's say 12%. So 18 is the top 25, bottom 25 are earning 12, 18, 12. When I'm looking at a private equity fund or a hedge fund, let's say the top 25 managers on an average are earning 30%, the bottom 25 are earning, let's say, -5, -7%. In which case is it very important for you to choose the bestest manager? In case of hedge fund private equity or in case of equity? Hedge fund private equity, because the gap between the best and the worst is barely 3 or 4%, 18, 12, 13 types. There's barely not too much gap between the top and the bottom. There's not too much difference between the top and the bottom. But when I'm looking at a hedge fund private equity, there's a huge gap. There is a huge gap between the top and the bottom quartile managers, the top performing and the worst performing managers. So here the demand for the top managers is going to be way more significant as compared to the bottom managers. The importance of manager, their skills, their specialized skills is very important. Henceforth, I will be forced to pay high management fees because the top quartile managers will demand high fees. And they will say, you want to pay me, you pay, otherwise you go. And you want them because these are the managers who are actually creating a large amount of return, a huge amount of return. There's a huge gap between the top and the bottom quartile performing managers. So they will charge high management fee and high incentive fee. So we'll discuss about the fee structure separately. But management fee and incentive fees, for example, if suppose I have invested 100 rupees in your hedge fund. On 100 rupees, I'll have to give you 2 rupees, 2% every year. Whether you make profit or loss doesn't matter because you're managing my money. So I'll give you 2%. If 100 becomes, if you generate more than 10% return, I will give you extra 20% share of profit also. So whether you want profit or not, I'll give you 2% management fee. And if you outperform, if you generate a return of, let's say, more than 10% or so, I'll give you a share of the profit also. Incentive fee. There is an incentive for the manager to outperform the market, in the market. Tell me, are you comfortable understanding this? Next, restriction on redemptions. Say suppose I have invested in a mutual fund today. Tomorrow I can easily sell my shares from the mutual fund. There are different kinds of mutual funds. Either I will share my mutual fund units to you, or I will tell the mutual fund that, I will give you my mutual fund shares, we call it units. You will give me back my money. What will the mutual fund do? Maximum they'll have to do is, they'll sell a few shares of LIC, HDFC, whatever, HDFC, not LIC, HDFC, whatever, Tata Motors or whatever they're holding, and they'll give me my small amount of money that I need. They have a huge pool, correct? So if I need the money, if I'll tell them today, tomorrow they'll give me back the money. Suppose I'm a private equity fund manager. Today I will go and tell them that, see, I need my money back. Will the PE fund manager be able to sell Swiggy's and Nykaa shares? Nykaa, though they might be able to, but will they be able to sell Swiggy's shares and Flipkart shares tomorrow and give me the money day after? That is not possible. There will be a notice period. I gave him money, he took huge amount of loan, bought Jet Airways and is revamping the company in 3 to 4 years, and tomorrow I will say, nahi, mere ko nahi khelna hai, I need my money back. It's not going to work that way, right? You're getting the idea. So, restriction on redemptions. You cannot redeem your investment. You cannot simply sell your investment. You cannot just simply go to a PE fund or a hedge fund that tomorrow I need my money back. Give me my money back. You sell whatever, I don't care. I need my money. You can't do that. Tell me, comfortable? Next is more concentrated portfolios. In a 10,000 rupees investment, I can have one HDFC, a few ITCs, a couple of Tata Motors and quite a few other stocks. But in my 10,000 investment, I cannot have a few land, a couple of hedge funds, a couple of private equity funds, a couple of gold coins. I cannot do that. Yes, with REIT, you can still invest a few thousand rupees in real estate. With gold ETFs now, you can still invest a couple of thousands in gold. But these forms have turned up. But normally, on an average, if you're looking at alternative forms of investments, it is going to be more concentrated positions you'll have to take. When you're investing in hedge fund, minimum ticket size could be $1 million. Tell me, are you understanding? So more concentrated portfolios, you'll have more concentrated, more bulky positions. Even if you want to take a real estate investment, you want to invest in a flat or something. I've seen people doing like 3-4 flats they'll have. And I know one of these guys, he's got 4 flats and he's not even rented it out. And he was interested in buying another one. And his idea was that in retirement, I'll sell one flat, I'll enjoy for 2-3 years. Then I'll again sell another one and I'll enjoy for 2-3 years. Or maybe I'll just rent it out 4 or 5 together and then generate wealth. But the problem is that you're not understanding, you're not comparing that what is the wealth that real estate is creating versus markets versus this or that. You'll have to understand the liquidity that Nifty or the markets at large offer you. But anyways, but the positions are concentrated. You've got a huge bulky investment in just one area, one floor of that one building. Are you understanding? Even if then you can have a more diverse exposure through an REIT, right? Which is investing in IT parks in Bombay, Bangalore and all those huge office spaces where they get crores and crores of rental income. Right? So, but generally when you see, now we have REITs and ETF of gold, electronic form of gold and all, but normally they are more concentrated positions. Tell me, comfortable? Also, the reason why we want to invest in alternate investments is less efficient pricing. So there is something called market efficiency. You will study when you do this, when you do equity. What is market efficiency? See, market is going to be efficient when the price in the market is the correct price. So the demand and supply, if everybody has all the information, correct information, then the market the prices will be the legitimate price, the price that should be. That is an efficient market. If people are able to buy and sell at good, correct, fair prices, I will call that market efficient. What is market? What is the definition of market? It is a place where buyers and sellers meet in order to transact business, to conduct sale, purchase at arm's length price at fair prices. So a market will be efficient when people can buy and sell at fair prices. In alternative investments, we've understood that the markets are relatively less liquid. Illiquidity is there. If you want to sell something in a short period of time, you're unable to, real estate and all. Because of lack of disclosure, lack of regulation, lack of transparency, you may not have all the data. So the kind of valuation or the kind of pricing in the market may be very different. Say for example, in the stock market, let's say a stock is very highly priced. Let's say an XYZ company is very highly priced. You cannot short sell. Mutual fund cannot short sell. Mutual fund is not allowed to short sell. Mutual fund cannot borrow shares from somebody and sell to the market, but hedge fund can. There are a lot of inefficiencies in the market in which alternative investments can capture. See, if I invest in Tata Motors, if Tata Motors deserves a return of 14%, I'm getting 14%. Because of the risk Tata Motors takes. Because of the risk ITC takes, I deserve a return of 10%, I'm getting 10%. Because I'm assuming that these are efficiently priced stocks. The Tata deserves a risk of this much. Tata is more risky, it deserves a return of 14, you will get 14. ITC is less risky, it deserves a return of 10, you will get 10%. In alternative investments, because there is illiquidity, because there is lack of data and all these specialized managers are there, they can figure out where there is undervalued stocks and all, undervalued investment opportunities. So where you deserve a return of 13, they might generate a return of 18% because not so many people are investing into alternate investments. How many of us are investing into private equity, hedge fund, real estate, commodities and all so much? Commodities primarily in the form of jewelry, a little bit of SGB, sovereign gold bond and all have started. I don't have any properties and all that I'm renting out or land and everything that I own. So ultimately we are not too many people are investing or experimenting into the alternative space. When there are less people, there are more inefficiencies and there are more opportunities to capitalize, to make a lot of money, to generate extra return, which we call alpha. If you deserve 14% return, you get a 14% return, that is fine. If you deserve a 14% return, obviously the more risk you take, the more return you deserve. If you deserve a 14% return and you get 16%, 2% alpha you have created. Extra return, excess return you have created. An alternative investment, because there is less competition, more specialized people, knowledge required, inefficiencies there, lack of transparency, regulation, etc. With all of these things, there are more opportunities of mispricing, undervalued, overvalued, etc. And to exploit those opportunities to generate alpha. Tell me, comfortable? So these are broadly the different types of alternative investments and broadly the characteristics of alternate investments. Tell me, comfortable?